Did you recently inherit an IRA? Before you withdraw the money or decide to leave it untouched, there are some important tax rules you need to understand. I'll explain the most important inherited IRA rules, including the 10-year rule, required minimum distributions, and several common mistakes to avoid. Hi, I'm Andy Rose with Andy Rose Wealth Management. Let's get started. Rule number 1, your relationship to the original owner matters. The first question is, did you inherit the IRA from your spouse or from someone other than your spouse? A surviving spouse generally has more flexibility. Depending on the circumstances, a spouse may be able to roll the inherited IRA into an IRA in their own name. Once that happens, the account is generally treated as the surviving spouse's own retirement account. The spouse may also be able to keep the money in an inherited IRA. That could be beneficial when the surviving spouse is younger than 59 and a half and may need access to the money because distributions from an inherited IRA are generally not subject to the 10% early withdrawal penalty. The best choice depends on the spouse's age, income, financial needs, and the age of the original account owner. Rule number 2 is most non-spouse beneficiaries face the 10-year rule. For many who inherit an IRA from a parent, grandparent, sibling, or another individual, the account may be completely distributed by December 31 of the 10th year following the original owner's death. For example, suppose your parent died in 2026. In most cases, the inherited IRA would be completely emptied by December 31, 2036. But this does not always mean you can simply leave the entire account untouched for 10 years. If the original owner had already reached the age when required minimum distributions had to begin, many non-spouse beneficiaries must take annual distribution during years 1 through 9 and still empty the account by the end of year 10. If the original owner died before required minimum distributions had begun, annual distributions may not be required during the 10-year period. However, the balance must still be withdrawn before the debt end. Because these rules depend on the original owner's age, date of death, and beneficiary designation, confirm your specific distribution schedule before taking action. Rule number 3 is some beneficiaries receive special treatment. Certain people are considered eligible designated beneficiaries and may not have to follow the 10-year payout schedule. This group can include a surviving spouse, the minor child of the original account owner, a disabled individual, a chronically ill individual, someone who is not more than 10 years younger than the original owner. Depending on the beneficiary and the circumstances, distributions may be spread over the beneficiary's life expectancy. However, special rules may apply when a minor child reaches adulthood, so families should not assume that the child can use lifetime distributions indefinitely. Rule number 4, traditional and Roth IRAs are taxed differently. Distributions from an inherited traditional IRA are generally taxed as ordinary income. Imagine inheriting a $500,000 traditional IRA and withdrawing all of it in 1 year. That withdrawal could push you into a significantly higher federal and state income tax bracket. That is why tax planning during the 10-year period is so very important. Instead of waiting until year 10 and withdrawing everything at once, it may make more sense to spread distributions across several years, especially during years when your income is temporarily lower. An inherited Roth IRA, however, is different. Qualified Roth IRA distributions are generally tax-free. However, most non-spouse beneficiaries must still empty the inherited Roth IRA by the end of the 10th year because the Roth account can potentially continue going tax-free during that period. The best withdrawal strategy may be very different from the strategy used for a traditional IRA. Rule number 5, avoid these common mistakes. And the first mistake is transferring the money incorrectly. A non-spouse beneficiary generally cannot roll an inherited IRA into their own personal IRA. The account must normally remain properly titled as an inherited IRA, and transfers should generally be completed between financial institutions. The second mistake is missing a required distribution. Depending on when the original owner died and whether required minimum distributions had already begun, annual distributions may be required. Third mistake is waiting until final year without doing any tax planning. Allowing the entire balance to build until year 10 could result in one very large taxable distribution. And the fourth mistake is forgetting about the original owner's final required distribution. If the original owner was required to take a distribution in the year of death, but had not completed it, the remaining amount may still need to be withdrawn by the beneficiary. Some final thoughts. Inherited IRA rules are more complicated than simply withdrawing the money within 10 years. You need to know whether you are a spouse or non-spouse beneficiary, whether the original owner had begun taking required minimum distributions, whether annual distributions apply, and when the account must be completely empty, and how each withdrawal will affect your taxes. Remember, we do not give tax advice, and before taking any distributions, make sure to consult with your financial advisor and tax professional. A thoughtful withdrawal schedule may help you to manage your tax brackets, avoid penalties, and preserve more of the inheritance. I'm Andy Rose with Andy Rose Wealth Management. If you found this video helpful, make sure to click like and the subscribe button so you don't miss future retirement planning videos. See you next time.